Hello everyone, and welcome to the first in this RSK Banking on ESG webinar series. Today, we're talking about the risks posed by biodiversity loss to financial institutions and what can be done to better understand these risks, as well as the subsequent opportunities to mitigate them and the negative impacts. So, before we get started, just a few housekeeping rules. All audience microphones are going to be muted through the webinar. That's not because we don't want to hear from you, but we would rather avoid all of the lovely ambient sound. If you do have questions, put them in the chat as we go through, and we'll get around to answering as many as we can in the Q&A session at the end. Next slide, please. So, your speakers today, and if everyone can just put their webcams on. My name is Tom Mason. I'm an Associate Director and the Corporate Biodiversity Lead at Nature Positive, which is an RSK Group company. Today I'm moderating the discussion, and with me I have three distinguished guests. Natalie Tong is a Senior Strategy Analyst and ESG Manager at AXA XL, UK and Lloyd's. Natalie joined AXA XL in 2021. Her role focuses on developing sustainable innovation products, managing ESG growth initiatives, and educating AXA XL colleagues and clients on important ESG topics. Before joining the insurance industry, Natalie helped corporate leaders to develop sustainability strategies and to facilitate innovation workshops across a range of sectors. Stephen King is a Senior Vice President of Business Development at Resource Management Service, RMS, one of the world's leading managers of forest investments for institutional investors. Stephen's got over 20 years of experience in the forestry and natural resources industry, and he's been responsible for investment-grade timberland portfolios and acquisitions in North and South America, New Zealand, and China. And last but not least, Mirta Castropelli is Managing Director and Global Head of Natural Capital at ISS ESG. Mirta has been an accomplished sustainable investment leader with a track record in developing cutting-edge research in the ESG investment space. She's a senior fellow at Columbia University's Center on Sustainable Investment, and most recently, she was the founder and CEO of Beyond Alpha, a specialized research firm focused on sustainable investment strategies. And before that, 12 years at State Street in various roles. So, before we get into the discussion, we've got a couple of questions to you, the audience, and I'm assured that this will all work smoothly with no technical issues. So we should have a slide coming up now on which you can scan the QR code or go to the Slido website and just give us your answers to the first question. So, is nature or biodiversity related risk already part of your business investment strategy? So it's yes or no, or we're in the process of it. So we'll give that about a minute or so, or maybe less than a minute, and just see what the consensus is. Okay, it's positive. The yeses are going up. Slightly down. Okay, it's good to see a lot of companies are in the process, I suppose, of getting this done. Give it a few more seconds, and perhaps we can move on to the second question. And the second question is, how confident are you in your understanding of biodiversity-related risks and opportunities? It's very confident, moderately, not confident, or if you just don't get it at all. It's an anonymous vote, so you can click the last one with no fear. Okay. Mostly moderately confident, some not so. All right, that's interesting. That's really good to hear. We've got a good level of confidence among the audience. So I think we can move off from the questions and actually kick off the webinar. So the title of our webinar today is, does biodiversity loss pose risk to financial institutions? It's a bit of a rhetorical question because we know that it does in some way. But in today's discussion, we're going to talk around some of the practicalities in assessing what those risks are. And I think before I go to our panelists, in a rather timely fashion, there's been a very important bit of research that's come from the Green Finance Institute in the UK titled Assessing the Materiality of Nature-Related Financial Risks for the UK. And I think it's worthwhile pointing out a couple of key headlines from that report. The first one is that the damage to the natural environment is shown to be slowing the UK economy and could lead to an estimated up to 12% reduction to GDP in the years ahead. So that's a larger hit to GDP than from the global financial crisis or from COVID-19. This accounts for cumulative effects of biodiversity loss, soil and water pollution, water scarcity, and exacerbated extreme weather events in the UK and affecting international supply chains. By comparison, the GFC in 2008 took around 5% off the value of UK GDP, and the COVID-19 pandemic took up to about 11% in 2020. So they're conservative estimates. And the short of it is, if you thought the GFC and COVID were a tough time for finance, loss and degradation of biodiversity and natural resources is going to be just as, or if not worse. So, first question to the panel. Obviously, we know that the impacts of biodiversity loss from a risk perspective are going to be bad, but it's not necessarily equal or as bad across all of the industries. So, what industries and what type of risks do you see are the most prominent in both the short term and the long term? And I think, Myrta, if I just pass to you to get us started.
Excellent. Thank you, Tom, for the introduction. I think you started with a good point, which is that nature loss affects industries and sectors in a very different way. Maybe just starting with a statistic, because before I go to the sector-specific question, is that when we did a survey last year with our institutional investor clients, we found that more than half of the survey, the participants in our survey said that issues of nature like freshwater usage, biodiversity loss, deforestation, and pollution were highly relevant or relevant for their investment decision-making process. These numbers in specific industries and sectors: consumer, industrials, energy, mining, and utility. These are very similar numbers that we see with climate. So we can say that nature is now as important as climate for investors in some of these, again, specific sectors. So it's clearly top of mind for our clients. When we look at specific sectors, the agriculture sector is clearly at the heart of the nature conversation. Just to give you some stats, around 90% of the deforestation that is happening today is related to agricultural practices. Agriculture is also the #1 polluter, of the water polluter in the world today, mostly due to the use of chemical fertilizers and pesticides. And also about 70% of the freshwater usage and withdrawals is also related to agriculture. So these are, again, just some statistics that shows very clearly that is really at the heart of a lot of the impacts that we have on nature. At the same time, agriculture is highly dependent on nature, right? So we talked about water, but we also can talk about soil, right? And the impact of extractive agricultural practices that have on soil, and that is creating the degradation of soil. And that has a direct impact into the yield and the productivity for a lot of these soft commodities. And as these soft commodities affect, obviously, the food sector, but obviously beverage, when you even think about textiles, rubber, and when you think about palm oil and household products. So soft commodities, any industry that has soft commodities in the supply chain will be affected as well with some of these impacts and dependencies on the agricultural sector. So we've done a lot of work in this space. We did a one-year research effort, specifically looking at risk and opportunities in the regenerative agricultural space. We developed a definition, 12 principles of regenerative agriculture, and this is how we're now assessing or food product companies, and also other industries with, as I mentioned, sub-commodities in the value chain, to understand these risks. But yes, I think agriculture is something that we're looking very, very closely, because we recognize and understand that that's really at the center. Obviously, we have TNFD, SBTI, that have already identified high impact industries. So we're, 10 to 13 of these high impact industries, so including, as I mentioned, textiles, but also, chemicals, forestry and others that also have very unique, again, risks and dependencies, that we're also looking closely. So yeah, we're starting with agriculture as our main theme, to begin with.
Yeah, and there's so many sectors that are connected and dependent on the agriculture business, like you say. Natalie, from the perspective of insurers, I'm sure you're quite aware of the connectivity of sectors and their exposure to risk. How is AXA looking at that?
Yeah, so definitely. I think it's really interesting because I guess we sit across two sides of the chain as well. So not only as a corporate AXA ourselves and other insurers and reinsurers like Zurich and Swiss Re, we already report on our nature impacts. I'm also looking to develop nature-based solutions to protect natural capital for our clients too. But it's also, we're thinking about the impacts that nature's going to be having for the clients that we serve as well. And I think there are lots of reasons that this is really important to us. And I think, Mette, you directly called on a lot of the work that we've been doing, that we've been looking into as well. And so a recent report that we found by the World Economic Forum, it was a global risk report, and they identified construction, agriculture, livestock, and food and beverage as the 4 largest sectors that are highly dependent on nature. And these sectors as a whole, they together generate 50% of global GDP. And the reason why this is important is that these sectors are also ones that the specialty insurance industry also have heavy footprints across. So it really showcases the leverage that we have to enact change for our clients here. And when we were looking into that from our specific risk perspective, we've been trying to think about what types of risks we could identify that would be impacting our clients in this space. And so we've been looking into potential reputational risks, transition risks, and potential political risks too. And we've been really seeing that these are key areas that nature and biodiversity are becoming more of a risk management priority for our clients in this space. And if we think about it on a longer term effect as well, it also could be a huge financial risk as well for our clients as well, if they're not thinking about how they're consuming natural resources in the present state and the ramifications this could have in the future. And then kind of linked to that, supply chain risk is integrated across all these industries. So it's kind of like compounding on top of each other. And that's also something I think the insurance industry, we haven't been very good at navigating this in the past, but it definitely, using nature as a lens, is really helping us identify the importance of supply chain risk.
Yeah. And Stephen, I suppose in the forestry sector, you're closer than most, maybe with the exception of the agricultural sector, to this. So what are some of the perhaps specific short and long-term risks as you see it?
Yeah, I mean, I think certainly that despite the threats differing between plants and animals, we're observing that climate change, invasive species, and land use change are probably the most common threats to all of them. In the short term, certainly non-climate stressors such as habitat destruction and fragmentation are some of the more significant risks that we see to biodiversity. In the longer term, probably more biodiversity risk associated with altered habitat conditions and the increased occurrence of extreme events, just to name a few. The forest sector can mitigate some of these biodiversity risks, certainly by keeping working forest as forest and active management. But these are things that are in some within our sphere of control and some not. So
yeah, I think the range of risks is quite complex, and really I think the key thing for, at least that we've seen as well, for a lot of businesses to address them is to have a better practical understanding of some of those real on the ground physical impacts that you mentioned, Stephen. So my second question to you would be, how are risks related to biodiversity loss and ecosystem degradation currently being assessed? And maybe Stephen, start with you there about your approach to doing that.
Yeah, well, lots of layers here, but given our asset class, but I guess first we assess these risks through monitoring protocols employed throughout the whole life cycle of a forest investment. So this is starts with monitoring forest operations. So we have monitoring protocols for planting, harvesting, all the various activities that we have going on in the forest. We have very well-defined protocols to monitor biodiversity-related issues. Second, we're collecting forest inventory data on a regular basis, as well as biodiversity data, and that helps us be more informed on the biodiversity issues. And then lastly, we're assessing in a more holistic view, assessing the health and the connectivity of the various habitats. So that's a really important theme in our asset class, is making sure that we're understanding and mapping these corridors and connectors for the habitats. So, and that involves foresters on the ground. It involves leveraging new technology. We engage a lot of third-party consultants or biologists that specialize in certain species, and we have a lot of partnerships with conservation groups. So.
Yeah, I think that's the really important practical stuff when it comes to that risk assessment, is actually measuring what's happening on the ground. Not a lot of companies are really ready to do that. So, Myrtha, I know from ISS's point of view, you're looking at many, many companies in many, many sectors. So for those companies that are not at the same level of detail as RMS, what are the approaches that they can use to assess biodiversity risk?
Yes, so we are assessing companies to your point, and we see different types of data sources, right? So we have reported data, which we obviously collect from corporate disclosures, and I'll talk about that because with TNFD coming along, there's going to be a significant increase. The hope that there's a significant increase in disclosures and granularity and comparability for a company disclosed for, again, publicly listed companies. We also have our model data or estimations of, similar, with footprinting tools, similar what we do with climate, if you will. For that, we have two particular metrics, the PDF, potentially diversified fraction of species, and MSA, mean species assessments, that are used to estimate using, scientific models and life cycle assessment to understand the impact on nature, on biodiversity, for at the sector level and all the way to at the company level and the company's activity level. And also we can tie it to a particular impact driver. So there's clearly a wealth of data that we're able to gather with some of these models and these specific metrics, the PDF and the MSA that I mentioned, that will allow an institutional investor really understand their exposures and the impacts from the impact side. In addition to that, we also have ecosystem services assessment models that could also be used to inform decision making and to understand the dependencies and exposures on nature. So I always said there's a myth that there's not enough data. There is definitely plenty of data. There's obviously, we could always get more data and better data, and I think there's a very quick evolution on the models that we are developing, but also, as I mentioned earlier, with improved disclosure that we're expecting to see over the coming years, with TNFD being adopted by corporates. So data is going to get only better as we move forward. But we have a lot of information today to start informing some of these decisions.
I think that's a good point, and that's a nice segue into the next question, actually. So you mentioned frameworks like TNFD, and these are a good starting point. But with biodiversity risk, for many companies, and we did see that in some of the survey results at the start, there's quite a varying level of maturity and readiness in respect to this. There is lots of tools out there. There's lots of data at a national level, regional level, lots of historic data. But I suppose the question is, what more do investors need to make nature risk assessments more effective in order to assure that when we're addressing risks, we're doing it with the appropriate urgency and the correct resources?
Yeah,
and Stephen, maybe.
Oh. Yeah, go ahead. No.
Yeah, I think from our side, we really need to continue to enhance data collection in technology. I mean, we manage several million acres in the U.S. South, and this is data that it's very time consuming to collect and expensive. And so developing and putting in practice cost-effective technologies that allows us to assess the presence of organisms, and in some cases without needing to see it or capture it, is really important. You know, so with commercial forest or forests, we have the benefit of the trees largely not moving. And so that makes the sampling statistics and designs, albeit complicated, more manageable than as it relates to, for example, animals and more broadly wildlife. So I think that we, tools that can help us in data collection for a wide variety of organisms is important. You know, so for example, we've been using eDNA, which, for example, collects samples from water bodies, and that detects genetic material that's left by organisms present in an area, and we may or may not have seen it. So we've started to employ and have been actually employing some of these tools for a couple of years now, like eDNA, to help us just get more robust data sets. So I think that's one. The second one is we really need to ensure the data that we're collecting is specific to the ecosystems that we're working in. So even in the southern part of the US, there is a wide variety of ecosystems that we operate in. And so we need that data to be specific to the ecosystem or to the specific organisms that we're trying to monitor. And then I would say lastly, in terms of the assessments, you know, just continued collaboration and knowledge sharing with third parties to elevate and validate the assessments. So.
Better.
Yes, no, and I would add to that. So I think Stephen mentioned some of these technologies that there are kind of location specific or asset level data as well that is going to be required. I would, and I want to add supply chain traceability. That's, I think, key to a lot of these conversations, particularly in the public equity space, right? A lot of these risks and dependencies are going to be along the value chain. So we need to really do our homework to understand those value chains. The NFD also recently released a guidance to assess dependencies and impacts along the value chain, which is, again, a good starting point to understand those exposures. But at the end of the day, and if you put my institutional investor hat on, kind of our client's hat on, it's really to do the homework and to do our materiality assessments, do the fundamental research at the sector level to understand these impacts using the data that we have available today to understand those exposures, and then do that company level assessment. So materiality and impact assessment, fundamental research needs to be done to be able to really take a more active role, both for asset allocation decision, but also for stewardship efforts. So the homework, we do need to kind of roll up our sleeves, use the data that we have today to start making some of these assessments.
Yeah, that's a good point, because not every company can do that. You know, gold standard eDNA assessment on their land, right? You have to sometimes take a higher level view at the sector, looking at material or materiality screening. Natalie, just interested to hear from the insurance perspective, because obviously the case by case risk assessment for biodiversity can be sometimes quite precise. So how does that look?
Yeah, no, definitely. And just kind of reflecting on what Martha was saying as well, I think there's so much the insurance industry could be leveraging from what the investment community have been doing as well. And so I think maybe there is potential to kind of leverage more of the tools and the understanding that they have, and kind of bring it across to the risk angle on our side too. But I think something that's really kind of come up as we've been investigating this space is really the potential to support nature through the lens of locality and local expertise. And Stephen mentioned this as well, and I just really kind of want to build a bit more on that point, is that for us at the moment, I think the tools that we're using, they are very good at seeing the global trends and seeing the bigger picture. But I wonder if there's more that we can be doing to really leverage local expertise that these experts who are on the ground all the time really understand, if there's a way that we can integrate that into global tracking. And especially when it comes to loss adjustment, I think us having quick access to on the ground specialists, local loss adjusters, and being able to leverage that global network much better, it's going to be really influential in how we can create nature impact on the insurance side. But yeah, so I think just kind of seeing if we can get more granular tools and technology that really understand the specific species, specific biomes, like tracking of animals and wildlife, and looking at those really smaller subsections is really going to help us leverage more.
Yeah, and I think between sectors, the requirements for data are going to vary quite significantly. But I think generally we are in a better place now than we were 5 years ago when it comes to being identify and evaluate risks. But I suppose what are the levers that we actually have as financial institutions to mitigate these risks? So how does that translate into actually taking action? Going from measuring things to taking action to address risks or opportunities. And I suppose, Natalie, perhaps you could kick us off there.
Yeah, of course. So with the work that we've been doing, we've been really looking at how we can kind of take a step back and take a look at the whole value chain and think about, like exactly like you mentioned, Tom, those kind of like cross-sector considerations. So a little bit of an anecdote, I promise it kind of links back, but just bear with me for a second. I was lucky enough to be part of a nature insurance summit this year, where a cohort of insurance professionals were taken to an island in the Hebrides in Scotland. And whilst we were there, we spent some time with a fantastic kelp startup where we were learning about the ecosystem benefits of seaweed. And with the experts there, they were teaching us about the multiple benefits of seaweed as a nature-based solution. So not only does the fast-growing nature and sturdiness of seaweed really lend itself well to creating seaweed forests and creating shelter and feeding grounds for aquatic life such as fish and dolphins and seals, but the seaweed itself also fixes nitrogen. So when it's harvested, it can be turned into natural fertilizers, which improves soil quality, like Myrta was talking about, for terrestrial farming as well. So I think when we took this insurance lens to this kind of ecosystem that we went and saw at such a small scale in Scotland, it made us realize that solutions can really be transferred back to the insurance industry as potential risk management solutions as well. So we could be offering up these types of solutions to our farmers to encourage them to take more nature-friendly approaches. And in addition to that, coming back to those cross-sector opportunities, one of our underwriters is currently investigating the potential for red seaweed to support in methane reduction when it comes to feeding cattle. And again, this could be another risk management service that insurers could be providing to our livestock clients alongside traditional policy offerings. So it's really thinking about this blending of emissions reduction monitoring and livestock underwriting. It wasn't really a connection that we'd have made unless we kind of went and started learning about seaweed and kind of thinking about the other potential that this incredible kelp could have. And then another final example for me is that alongside indemnity style products, so which is where insurance policies require a loss adjuster to come in to adjust the claim. The insurance industry has also been investigating parametric insurance, which is when this policy is triggered, it creates an automatic payout. So AXA Climate, they're the parametric entity of AXA. They recently announced that they're developing a parametric insurance product, which is protecting fishing communities, which are responsible for the restoration of mangrove forests in Mexico, to help them against the impact of hurricanes. So in the event of a natural disaster, this insurance policy will facilitate rapid financing for the restoration of mangroves, as well as repairs to related infrastructure support with fishing and ecotourism as well. So I guess those kind of a few examples about how the insurance industry at a small scale and kind of like smaller subsectors are really trying to think about innovative ways of creating impact for nature.
Yeah, I think one of the interesting things you mentioned there is it's really about the application of nature-based solutions as a way to mitigate risks, or to mitigate risks which can stem from impacts. So impacts like greenhouse gas emissions or ecosystem degradation, and investing in nature-based solutions to mitigate those. I suppose, Stephen, from the forester's perspective, you have loads of opportunities for nature-based solutions. And I suppose people typically think of carbon emissions and carbon capture, but from the biodiversity angle, what kind of opportunities are there to mitigate risk?
Yeah, I mean, two broad different ways you can slice and dice it, but one is, doing more good and doing less harm. And so as we start thinking through, let's say, a mitigation hierarchy in that context and what we can do, I'll focus on things that we can, as foresters, that we take action on. And so as the concepts on growing trees are pretty few, we know they need nutrients, water, and light, but the methods and that obviously supports biodiversity. The methods are many. So as we think through like what we do on a daily basis, you know, we're preventing conversion of areas with significant biodiversity. We're establishing buffers around water bodies. So that's a significant action that we take to protect not only water quality, but the surrounding biodiversity in these streamside management zones. So these areas are really important corridors for biodiversity, especially animals, and they provide the corridors and connectors that I've referenced earlier. We also manage commercial forests to provide a diversity of age classes. So there's been studies that have shown that diversity in age class actually is an effective tool to increase in bird populations. So it depends on the forest structure and the species and consideration of bird species, but those populations have responded positively to changing or that diversity in age classes. We also manage tree density within a forest. That tree density improves not only the management of that density improves the health of the forest, but it also improves the biodiversity of the forest. We have certain species like, for example, the red-cockaded woodpecker. It requires a low density forest ecosystem. And so we need to understand for certain species, what is that density that is best for them to thrive. And lastly, just developing actions around protecting and introducing at-risk species, both flora and fauna.
And I suppose sometimes there has to be a bit of a trade-off there, right, between the biodiversity opportunities and the yield of the forest, really, the economics.
Yeah, there can be, but it's sort of one of the benefits of the asset class is we can offer financial return and at the same time provide meaningful benefits on biodiversity. I'm not saying that we're perfectly unique in that sense, but we're fairly unique in that regard.
Great. And Murta, actually, I want to pick up on a point that you mentioned earlier and thinking about supply chains and value chains. There's obviously some quite significant systemic risks to a number of industries as a result of the combination of climate change and biodiversity loss. How can financial institutions ensure that the necessary change is actually happening? And here, perhaps thinking about things like stakeholder engagement.
That's a very good point. And supply chain, as I mentioned earlier, is really where a lot of the impacts is, but a lot of the risk and exposures are, right? Especially if you are, again, supplying basically your key raw materials from, let's say, smaller farmers or locations in emerging economies. So one example, one thing that that is an important tool, so maybe answering your previous question. So one key tool that investors have is obviously stewardship, right? And shareholder engagement. So when we think about shareholder engagement, we can think about, engaging with companies to increase disclosure and transparency in how they're managing and assessing their risk, how they're identifying risk, how they're managing risk. But also shareholder engagement could also be used to think about the strategy of the company. How is the company innovating? How are they, as they identify the risk of nature loss, how are they working with their suppliers to create that resilience that is going to support, at the end of the day, a long-term business model, a long-term value proposition, a competitive advantage. So in the food industry, one of the things we've seen is that large food companies, again, just to give you an example, have actually are working with small farmers to support them in their transformation or their transition, I should say, to sustainable agricultural practices that will ensure the protection of the topsoil, and that is going to increase the resilience of their crops. This is directly related to operational risk and supply chain risk. So they're actually been investing with and working with small farmers, paying premiums potentially with some of these crops, supporting with technical support, working with cooperatives to help kind of transform the way that they're doing their business. Also working with government officials. I know here in the US, we have, with the USDA has a large project around regenerative agricultural practices and working with small farmers to the extent that, you know, these large, let's say, food companies could be working with the government to support, again, the small farmers, because at the end of the day, a lot of these supply chains are not necessarily part of, you know, they're not necessarily owned by the large companies. So to what extent, what are some of the market signals that a large corporation could be sending or providing to the small farmers to support that transformation? So that's an example of kind of that value chain view, that vertical, not full vertical integration, but looking at all the aspects along the value chain to ensure that the raw material is going to be there to support the business at the end of the day. So, and then when you add that across the country, so again, if we go to emerging economies, this is going to be even more important. So I mentioned operational risk, but I also want to, since I'm in the topic of supply chain, I do want to mention regulation, right? So we have the EU deforestation law that came out that is going to require companies that are doing business in Europe and European companies to look at the supply chain traceability to ensure that there's no deforestation or newly deforested areas in their supply chains. That goes all the way to these emerging economies that I mentioned, markets that where the raw material is coming from. And we also have the CSDDD, the Corporate Sustainability Due Diligence Disclosure, that is also looking both at social issues, but at environmental issues along the supply chain. So we have two key regulations that is going to put emphasis on large companies to start looking at the environmental impacts and their exposures of nature loss across the value chain. That is going to be, again, another aspect to encourage both companies and investors to look at these issues more closely.
Mm-hmm. Yeah, I think that's very powerful, because actually it's not enough to just assess and identify these risks like the EUDR, but you have to take action directly to address that where you are exposed to the risk, and you have to do it quite quickly. And there I think we come back to the topic of having the right data and also being able to engage with the supply chain. So I know we've sort of moved through the discussion from risk identification almost to the opportunities through which you could offset that. So I suppose thinking about those opportunities, how are financial institutions evaluating the most impactful opportunities or the most effective risk mitigation actions? And I suppose a bit of a wider question, how are we actually measuring the impact of those actions to reduce or mitigate risk? Natalie.
I like not knowing where you're going to take us, Tom. But yeah, I think kind of, so starting with your kind of like first arm of it, I think it's kind of difficult to quantify thinking about the opportunities at a global scale. I think for us, we've had, I don't want to call it success yet, but I think some of that we found a bit easy to kind of contextualize the space is looking at it back at a local scale. So a live case study that we have at the moment is with the new biodiversity net gain legislation in England. So the UK government, they introduced BNG early this year, and it represented a real significant shift in planning regulation for a few of our clients. So what this regulation means is that, means now in England, when a developer undertakes a project, this legislation mandates that they must provide a minimum of 10% of biodiversity net gain by the end of development, and the habitat they create must be enhanced and retained through biodiversity for a minimum of 30 years. So in the specialty insurance market, there's been increased coverage around BNG risks and how we can support our clients as they navigate this legislation. And for the past few months, our team has been working with our clients and other stakeholders in the market to try and figure out what are the stress points that our clients could be facing and if risk transfer would be applicable in the space. So from our research alongside our legal partners and ecologists and different environmental consultancies, we think we've managed to identify a few potential risk transfer solutions. So for example, our environmental impairment liability teams, they could be engaging with landowners who are now having to think about how to secure the biodiversity for the next 30 years and see if we could offering protection to them, support with that. Or it could be working with our professional indemnity teams who might be able to support ecologists who are auditing these developments, where if they incorrectly calculate BNG, this could have significant financial implications for the developer. Or it could be just adapting traditional risk hazards that we usually support with, such as flood or drought or damage to habitats during the 30-year period where BNG might be retained for. Or it could be working with our construction teams to help them see if there's potential support we could offer to clients if there are increased costs or delays to developments. So we found it a really interesting case study for us to use, because I think the regulated nature of this biodiversity intervention really allows us to see the investment impact of the nature as well. So I was part of the forum a few weeks ago, where we heard that a multi-million-pound development project which has come through the insurance market, which is now subject to BNG, spending up to a quarter of their budget on achieving BNG. So we're really beginning to see the clear financial considerations that investing in nature has for our clients. But it's also really encouraging because it's also giving us clear incentive to innovate, and we're already seeing this tangible outcome that we can be providing at the same time too.
Meta, how are agricultural companies, I suppose, as one example, addressing these kind of risks?
Well, so I mentioned the example of working with the small farmers, right? First of all, a lot of these impacts, so we talked about it's sector specific, it's location specific, and it's also commodity specific. So we're talking about soy versus coffee versus cocoa and palm oil. We're going to have completely different, approaches. If you are, if you're a producer or if that particular commodity is in the supply chain. So the work is definitely very, very specific to even that commodity. So again, without naming names, but we have seen large companies that have really embraced the concept of regenerative agriculture. And when I talk about regenerative agriculture, it's really about the protection of the soil, moving away from the monocultures to provide, crop rotation, what type of fertilizers and pesticides are used, so more use of biological inputs, creating biodiversity, buffer zones to support with pollination. And so there are all these different aspects that are necessary for a regenerative agriculture model that will protect the soil and will protect the yields going forward. Because as we continue to eliminate topsoil with the current practices, the risk is crop failure. And obviously that would increase the cost of those commodities significantly. So a lot of these companies, like I said, are working sometimes with governments to really support the small farmer, because at the end of the day, they're at the front line in some of these. They are the ones that are actually, working in the land, and we want to make sure that they actually have the right level of support, both from the government, but also the market signals that are necessary for them to engage or to take on those type of practices. So I would say that is something that we welcome. Specifically what we've seen with issuers, with again large corporates, is that they assign X percentage of their sourcing comes from regenerative agricultural practices. So we want that number to continue to grow up, and again to ensure that those crops get, and they're part of their operations and part of their current profitability and margin models. So yeah, so I think that would be a specific example. There obviously, from the impact investor side, we've seen some interesting examples of investing in regenerative practices in different parts of the world. So you see in Africa, there's some examples with some calculations about how is that affecting, how is that actually is improving yield versus the Amazon. So again, it's also location specific, but we've seen plenty of evidence and now from various regions that these type of practices support higher yields and more sustainable yields in the future.
Thanks, Martha. And Stephen, how do you, from the forestry perspective, go about prioritizing risks and determining where you allocate your capital to mitigate potential biodiversity related risks?
So at the asset level, for us, it really starts with making sure you know what you have. And so one area that we're continuing to evolve and improve on is developing biodiversity footprints for the assets that we manage. So really understanding at the holistic level and at the more granular level, what does that biodiversity look like? And that anchors the, let's say, the roadmaps that we develop thereafter on the strategies and prioritizing what we want to do. So I think that's one, is making sure you understand what you have from the biodiversity footprinting. Then taking that the next step and screening for stress factors alongside that biodiversity footprint to understand where we can have the most impact. So an example would be identifying areas that might have, let's say it's in the Carolinas or Southeast Georgia, elevated risk of forest conversion, maybe to development or to agriculture. And then overlaying on top of that, the biodiversity priorities to see where that overlap happens and help us understand, okay, where do we need to focus on, at least in the near term. Obviously, again, to do this right, we've got to have the data. We have to have eyes on the ground, and continuous monitoring and biodiversity inventories and habitat mapping. So these are all things that our sector is evolving and responding to this opportunity, and it's exciting, but it's a lot of work. I think second to that theme is developing then indicators, maybe ecological indicators that would allow us to track improvement over time. I think that needs to be pretty bespoke for that to be meaningful and to be able to, of course, show support for the commitment and a progress towards some sort of high impact strategy.
Great, thanks. And so last question, actually, and we're coming to time. I do want to leave a bit of time for Q&A, so quick answers, but I want to take a bit of a step back. Investments into mitigating climate risk or energy transition and low carbon projects, Paris-aligned projects, have been significant, but there's still a massive funding gap for the same investment into nature risk mitigation. It's something like 700 billion at the global scale that we're missing in financing into nature risk, impact reduction, nature-based solutions. Obviously, by better understanding nature-related or biodiversity-related risks, we know where to invest. But what do you see are the major challenges to doing that at the moment? And perhaps Natalie, start us off, because I know you have some ideas about the insurance sector can potentially be an enabler for industries to take action.
Yeah, cool. Okay. So I think starting with the challenge, I think the biggest challenge for us currently is that I think we're still figuring out how we put a value on nature. So to be able to indemnify it like other insurable assets, we need to kind of be able to put the financial value on that. And I think, unfortunately, that's not something that we can do alone. I think it's something that requires a lot of industry collaboration, cross-industry collaboration, and also like governmental support as well. So that's kind of the biggest challenge that I think we're seeing, and to be able kind of to really accelerate the impact we could be having. But moving to positive, like I mentioned, case studies like BNG, trying to adapt our existing specialties to new areas to integrate nature risk is really important. Leaning on innovative forms of insurance like parametric insurance to help support nature-based solutions. And wider, exactly like you say, Tom, like how can insurance be an enabler for industries too? So could we potentially be leveraging investment arms that insurance carriers also have and working more cross-collaboratively to make sure that we're aligning on our nature strategies and the impact that we're having as two arms of a financial institution. It could also be working with our clients and creating clear industry consortiums to make sure that we understand the underlying risks that they're really concerned about when it comes to navigating the space, and also leveraging other risk management services like we have, like our risk consulting arms, like our engineering arms, to create more tools and measurement tools to measure impacts and other risks that our clients are going to be continuing to face as they navigate this new area of concern, or not concern, of opportunity.
Marta?
Yes, I think the challenge that I see right now is still a lack of, a comprehensive understanding of nature-related risk, impact, and dependencies. We at the end of, as I mentioned earlier, we do need to do our materiality assessments. It comes down to materiality assessments for a lot of institutional investors. And without understanding those dependencies and the exposures, we won't be able to really kind of move forward with, effective strategy, both, like I said, for asset allocation, but also for stewardship. So I'd say that the largest challenge is, or the biggest challenge is that lack of understanding or lack of deep understanding of a lot of these issues that are very complex, right? There's no one metric that we're now focusing on. We really need to understand it at the industry level, at the commodity level, and understand some of those, how things are interconnected. So as Natalie said, I think collaborations are going to be key. We need to bring kind of the finance industry, the investment industry closer to science and to the scientific community. And I know organizations like TNFD, science-based targets as well. So many excellent initiatives that are out there that are doing, kind of bringing all the different stakeholders together to increase that understanding and to increase collaboration. Like I said, at ISS ESG, we launched our Natural Capital Research Institute, I should say, just a few months ago, which is exactly dedicated to do that, to advance the understanding of how nature affects companies and investment portfolios, with the intention really to continue to go deeper and to collaborate with different partners to be able to provide some of those insights to really, like I said, start making some changes, Tom, to your point of the action side. The action piece of the equation, that is we're still not there yet, given the challenges that we face.
Thanks. Stephen?
I mean, on a positive, we're certainly experiencing an elevated conversation on biodiversity with investors, prospects. I would say when we're on the road talking to investors, it's a significant part of the themes that we see, especially in Europe. I would say our clients also requested more information on this topic. There's just probably going back to challenge, there's a wide variety of requests and understanding that we're navigating right now, and trying to understand what the marketplace is trying to achieve, and it varies a lot. And because of the data collection is expensive and time consuming, we're trying to navigate that as well. But it's exciting. I mean, it's inherent in the asset class. It's one of the inherent benefits of timberland. So we see this as this beginning of this journey, and just being patient, which is what most foresters have to do. So.
Right. That was the last question from me. We've had some questions coming through the Q&A channel, so I'll just select a few. I know we're a bit short on time, so we can keep answers fairly brief. First question is, how reliable are materiality screening tools like Encore for assessing risk? And I suppose the question there is how granular are they, and can they be trusted to a high degree of confidence?
Well, I'm happy to jump in here. I'm not going to speak about Encore because that's, again, not something that I'm familiar with, but we do have, as I mentioned earlier, our biodiversity loss impact assessment tool, using the two metrics, the PDF and the MSA, that are now, accepted, mentioned by the TNFD and some European regulators. That has been, it's now becoming more, like I said, more widely used. There is a very, scientific method behind it, using different, the life cycle assessment model, and I do think that provides a starting point. I feel like definitely there's going to be improvements that we see as technology improves, as we have information about, asset level data, but it is a great starting point that to really understand some of those impacts and dependencies. Obviously, if there's to the person that asked this question, happy to, feel free to reach out, happy to provide some more details of the methodology of both our PDF and MSA measures for biodiversity footprinting.
Any other comments? Next question. This is a tough one. How are you quantifying biodiversity risk? Any takers?
Well, I know, Natalie, you mentioned the value of nature is a tricky one. It is very hard. It's how do you measure negative externalities, right? It is a very hard question. I do think talking about, there is qualitative aspects that we need to consider. However, I think with nature, now that we don't have these disclosures at the level that TNFD is hopefully going to get us there in the next few years and other initiatives, there is information we have today that we could use to start understanding the direction of where we need to be, right? We have data around water usage, water pollution. We have model data with PDF and MSA that I mentioned earlier. We have data today. The quantification piece, it's hard. I don't know if we're going to get there. Again, that's my personal opinion, just because I've been maybe in the space for so long. But I don't think we need to fully quantify nature in order for us to take action. And I think that's the bottom line for me. We need to take action. We won't necessarily be able to fully quantify nature, but I don't think we necessarily need to do that in order to make a materiality assessment. My background before this, I was in the emerging market space. We had to do it, assess investment opportunities with qualitative data, with imperfect data, and that's basically the nature of the job of an investment professional, right? So that we shouldn't be scared by not having the perfect quantifiable data to make decisions.
Okay. I won't make anyone else take a stab at that question. It's a tough one. And let's go for the third and probably the last one in the interest of time. Can you give some examples of some effective nature-related opportunities that financial institutions can invest in?
It's a lot. Wetland mitigation. Yeah. I mean, my exposures are clearly biased with timberland, but I mean, the full spectrum is there. Any more specificity to that
I
question?
completely agree with you, Stephen.
It was an open-ended question. There's a good one just come in. Perhaps we can go for this one. Do you think that environmental legislation that obliges companies to higher investments in ESG measures and protection of biodiversity help to take more action? Like a percentage of the... Do you think? Sorry, I'm just trying to put this in shorter terms. Basically, is ESG legislation going to drive investment into biodiversity risk mitigation? I suppose we see that with EUDR is a positive example of it, because we already see that forestry companies are looking very closely at their supply chains now. They're increasingly trying to pull together at least smallholder producers into consortiums to have better, I suppose, oversight over the regenerative forestry practices. Do you see that that's going to perhaps affect other industries?
So I would say yes, right? We obviously, I'm based in the US, so the US and Europe is kind of the carrot versus the stick approach, but the you know, you mentioned the deforestation, you know, regulation, and I you know, the CSDDD, for instance, it's really putting more emphasis on some of these issues. So, you know, it does help. But again, it is, you know, dependent on the market, right? And the carrot versus stick, you know, a lot of investors argue that we need both, but it's just a matter of the level based on the market. But I think overall it is a positive step in this space, at least to increase awareness.
Agreed.
One more question, because I do like this one. So you mentioned that it's essential to know the biodiversity footprint or baseline of your project. And this is linking to large-scale project finance. For many projects, they follow the IFC performance standards, in particular IFC PS6 for critical habitat. And perhaps this is a question, Myrta, for you and also for Stephen, thinking about forestry projects. Are the IFC performance standards being used as an assessment for early stage projects to create a baseline and to assess the variability of impacts between projects? Or is it perhaps not something that's on the radar for many institutional investors?
I mean, certainly I've seen in certain geographies outside the US, the IFC standards being referenced for a host of topics, including biodiversity. I think I would make the distinction between what they're trying to achieve versus the specificity that I was referring to earlier with the biodiversity footprint, which those standards are not that prescriptive and weren't intended to be that prescriptive. So I think that it's not an either or, they're just different purposes.
Okay, thanks. There are some other questions, but I think we're at time, so I'm going to end it there. Natalie, Stephen, Myrta, thank you for being such great guests and for sharing your insights, and thank you for everyone for your questions. The next webinar in this series is going to be after the summer holidays. We're going to be looking at the dual implementation of TNFD and TCFD, and also talking about some of the interesting things we're doing with scenario planning. So thank you once more to everybody, and see you next time. There will be a recording available on the RSK YouTube channel. Thanks, everyone.
Thank you.
Thank you.
Thanks so much.